Welcome to the Unity Forum, a cross-partisan program dedicated to fostering reasoned discourse and a more open society. In each episode, we talk with well-established experts to provide insight on recent events, elevate civil dialogue, and encourage greater mutual understanding on social, economic, and legal issues. Our host is Chris Malone, founder of Fidelum Group and author of the award-winning book, The Human Brand: How We Relate to People, Products, and Companies.
Hello, I'm Chris Malone, and I'll be your host for today's discussion. Thank you for joining us. Our guest today is Dr. Pat Harker, a distinguished scholar, academic leader, and public policy expert with a career spanning the highest levels of academia, government, and finance. He currently serves as the Rowan Distinguished Professor at the Wharton School of the University of Pennsylvania and as Director of Academic Engagement for Penn Washington, where he helps connect the university's thought leadership with national policy discussions in the nation's capital. From 2015 to 2025, Dr. Harker was the 11th President and CEO of the Federal Reserve Bank of Philadelphia, where he played a pivotal role in shaping U.S. monetary policy as a member of the Federal Open Market Committee. Prior to his tenure at the Federal Reserve, Dr. Harker served for nearly a decade as the president of the University of Delaware, and earlier he served as the dean of the Wharton School at the University of Pennsylvania from 1999 through 2007. A recognized authority in management science, financial services, and economic policy, Dr. Harker has authored or co-authored more than 100 scholarly articles. His research has advanced understanding of how financial institutions can use data and modeling to improve efficiency, manage risk, and serve customers more effectively. His experience as a scholar, academic leader, and central banker gives him a rare combination of real-world insight and institutional knowledge. Welcome to the Unity Forum, Pat.
Thanks, Chris. Thanks for having me.
You're very welcome. So to get us started, I'm hoping you can tell us a little bit more about this new position you have at Wharton, and in particular, the Director of Academic Engagement for Penn Washington. What does that mean, and how did all that come about?
So again, thanks for having me. So I have two roles here. One is a faculty member at the Wharton School. I'll be teaching a class starting in January, a class on financial services technology, and so I'm really looking forward to that. A little nervous about it, to be honest. I've been out of the classroom for quite a while, and so, but I'm really looking forward to it. The other piece I have is, as you said, helping Penn build out its public policy presence. And I put Washington in quotes, although there's a physical site in Washington, which we'll use for many of the outreach efforts. I think that the outreach is more broader than that. You know, as many of you know, it's been a long time since Penn's had a public policy school. So that's the way it's going to be. But what we're doing now is my job is to source really good, fact-based, hard-nosed research on policy issues, not that are just the burning platform of today, right? The bill in front of Congress right now, but longer-term issues that where Penn's leadership, Penn's scholarly leadership can have something useful, meaningful, important to say about these topics. So I'll give one example, and one of, I think, many. I'll start here at home at Wharton. The Penn-Wharton budget model, I think, is really recognized on Capitol Hill and throughout Washington as a trusted source of information, of objective, fact-based estimates of various policy alternatives. So building on that kind of work, we want to bring other such ideas to Washington on a regular basis. And again, the idea is not to basically, in my mind, is to park ideology and let's just focus on what we know, not what we believe, right? And I think that's really important, that we're bringing our scholarly heft to the debate on a regular basis.
I'm wondering, in your experience as a university leader, is this a common thing that universities would have this kind of outreach to Washington, or is it relatively unique in that regard?
I mean, others have done it. I mean, everybody has a campus, and there's other things we're doing in Penn, Washington too that are student-based, where
Mm.
students are doing internships and other activities. So it's not just this academic content I'm talking about, but people do try to reach out in various ways. But I think there's a broad recognition at the university, and that's why the university started this, to the Penn is punching below its weight when it comes to influencing policy. And we have a great geographic advantage being right up the road, but I think it's time for us to, show off our stuff in a more aggressive way because I think we've got a lot to offer in the policy space.
Terrific. Well, we look forward to seeing what comes from that. So the Fed has been in the news quite a lot lately.
A little
Just
bit.
last week, they announced a quarter-point rate cut coming out of the Federal Open Market Committee meeting. What's your take on that? Do you have the sense that that particular decision was made independently on the basis of data, or do you think, perhaps political pressure or other things are starting to influence those decisions? How should we think about it?
So having spent a decade in that room, the Federal Open Market Committee room, I don't think it's political pressure. Uh, I think the Fed really is good at not bringing politics into the room. I don't know what's inside everybody's mind when it comes to that, but I can say it never enters the conversation. In terms of anybody verbalizing that, it just doesn't. I mean, in fact, this back to what we were talking about with Penn, Washington. The Fed's a great example of a place where you don't say anything in that room unless you can back it up with facts or a solid theory. Um, it's really important that we have that debate, and we don't always agree, but because we're looking at the same data, but we may have different interpretations of it, different risk tolerances about where we think the economy is going. So I don't think that was much of an issue. Look, the pressure is pretty intense. It's not the first time in Fed history that there's been this pressure. We can go back to the 70s with Nixon and Burns. So it's not we haven't had it for quite a while though, but it's quite intense. And that said, I think it was surprising to me actually that there was no dissent in the meeting. I thought some people might dissent. So in that sense, people might have rallied around the chair, which is often what one might do, except for one vote. Um,
Right.
and but I I was on the fence about this 25 basis points, to be honest. So if I go back to my last uh, survey of economic projections, SEP or the dot plot, my last one was in June because it's done every other meeting. And I had penciled in there 2 rate cuts for this year toward the end of the year. But we're in a period right now. It's a very difficult period for the Fed right now. Uh, we Nick Timmerose from the Wall Street Journal coined the phrase, so I have to give him credit, stagflation light. It really does feel like we're heading a period of stagflation light. Um, interest, the the unemployment rate is just bouncing along. They're getting mixed signals, like today's new claims were less than expected. So we're getting mixed signals on the labor market, but it's still choppy and, you know, unemployment's ticking up. I had penciled in by the end of the year, unemployment would be around 4.5%. So we'll probably see it tick up some. Uh, Inflation is sticky. It's not moving down. If anything, it's going to move side. In the best case, I think it'll move sideways or tick up a bit as these tariffs start to roll through. And they're not going to hit all at once. It's going to be a period of time. So if you talk to an economist, the textbook explanation of tariffs is the price level goes up once and then it just stays there. Now, it is. I don't think that's the case here. I mean, we're absorbing this. It's going to take a little bit of time, so you're going to see price pressure. Look, it's not the 1970s, so it's not the kind of stagflation. I mean, I'm old enough to remember Gerald Ford as president and whip inflation now buttons. That was how we're going to solve. I don't know what the buttons were supposed to do to whip inflation.
Right.
I had one as a kid. I don't know what I did with it. That we were not in that scenario. There's a lot more credibility the Fed has. lost a lot of credibility in the 70s. But this is the situation where which direction you go is not obvious, right? I mean, it's obvious, like when the pandemic hits, what you got to do. You got to take rates down, you got to save the economy. It's obvious when inflation's running out of control, what you got to do. You take rates up. But in this case, the Fed does have this dual mandate, and now you're on either side of the dual mandate. You've got things moving in the wrong direction in both ways. And which one do you take on first? That's a judgment call. And again, that's no model's going to tell you what to do. In fact, if you look at the models, for those who are macroeconomists, aficionados out there, you can take any version of the Taylor rule, which is very well known within macro world. There's various versions of that and other rules that tell the Fed what they should do. The rules basically say, except in one case, stay where you are, and one even says go up a little bit. Nobody's saying dramatic. Nobody's saying drop the Fed funds rate 200 basis points. It's just not in the cards.
Yeah. Yeah. Now you mentioned dot plot, back from
Yeah.
June, and you brought along a slide of a dot plot. And I'm going to go ahead and share that. And
Yeah.
I wonder if you could tell us more about what we're seeing here.
Right. So there's a story here. So again, this is, I have to say, Fed insiders, FOMC participants really don't like this plot. What do I mean? I mean, they're not really thrilled generally with the SCP, the whole survey of economic projections. But in this case in particular, people often get their backs up for good reason. This, I want to be very clear. This is FOMC participants' assessment of appropriate monetary policy. It's what they think should happen based on their forecast. It is not a commitment of what will happen. That distinction is very important because the market basically takes it as a commitment, often. But there's a lot in these dots. There's a lot to read in this ink blot here that we're seeing. So if you notice, 2025, we're coming toward the end of 2025. So the dots are pretty well aligned. They're basically, if there's a median, it's for 2 rate cuts, pretty much where I was in June, except for the one outlier below. We can talk about that out.
Yeah. And if I'm reading this correctly, those are individuals' views of
individuals.
what they think is appropriate.
Right.
Yeah,
all 19 members put there's dots on what they think the GDP will be, what unemployment will be, what inflation will be. And then this is their projection of what they think policy should be. Mm-hmm. There's 2 takeaways from this, though. Go all the way out to the longer run. Look at the dispersion of those dots. I, in my 10 years, never saw it that wide. Because normally, as you come toward longer run, you're starting to see convergence, actually. So that you'd have inflation, and the underlying variables would be inflation's running at 2% because the Fed does its job. Unemployment is near the natural rate, and that call it 4 point something-ish, right? And then the appropriate policy is pretty simple. The appropriate policy is the neutral rate, or in wonk world, R star, plus inflation. And that would be what the neutral rate is. That, I've never seen this. So this tells you a couple of things. One is, and you go back through the other years, there's a lot of divergence in the committee of where they think policy is going. So yeah, the media reports the median dot. The median doesn't tell you a whole lot here. I mean, there's wide disagreement. Now, by the way, we've debated this in our monetary policy framework in years past. Other central banks put out a consensus forecast. Look at those dots and tell me how you're going to put out a consensus forecast of the 19 participants. So that's off the cards for the Fed.
Yeah. A lot of variance in that sample.
The second piece, right. So just so you know, there's a lot of uncertainty facing our economy, and you can see it in these dots. The second thing I take away is go back to the longer run. Go back again to that longer run rate should be inflation plus the neutral rate, what you think the neutral rate is. Most economists, John Williams, the president of the New York Fed, has a famous paper with Laubach and others have estimated R star, because R star is really a longer run concept. Short run R star doesn't make a lot of sense. Most people have it at 1.5%, 1%, maybe 1.5%. You've got people with these dots all the way up to 2% R star. That is a huge bet that AI is going to dramatically improve productivity of the U.S. economy.
Wow.
I mean, and there's other forces, global forces that impact R star too, and demographic forces play a role. But that is a huge bet that you're going to see this big productivity increase. I would encourage people to look at the Penn Wharton budget model, just put out a study on the economic impact of AI. Yeah, there's going to be a productivity increase, but it does peter out. It doesn't last forever, like any general purpose technology. So we will see a bump, but then we're going to go back to trend. And so 2% R star is pretty hard to believe. I tend to be, again, back in the camp around one-ish, which would put you where if there is a consensus, there's 4 dots on the line of 3%. That's pretty much where I would land.
Got it. Very, very interesting. Thank you for sharing and explaining that. Now, also last month, you authored an op-ed piece in the Wall Street Journal entitled Public Ignorance and the Fed Independence,
Yeah.
A Misunderstanding of the Central Bank's Role Foments Cynicism. And in it, you assert that maintaining Federal Reserve independence is essential to economic stability, as well as better public understanding of what the Fed can legally and economically control. So I wonder if you could tell us a little bit more about that for those that may have missed it, and what the thrust of your points were.
So I used a story in the op-ed. So when I first got to the Fed, soon after I got to the Fed, there was a group fed up who was protesting the Fed. So I met with a group of them. And there was one guy who was pounding the table, literally pounding the table, demanding that, and he reminded me many times he had a PhD from MIT in economics, and my attitude was, look, we're all above the smart bar. That's fine. We could all just have a conversation. He's like pounding. It's like, how dare you give loans to banks and not to struggling nonprofits and community organizations? Going on. I finally had to do one of these. Time out. I don't do that because it would be illegal. Is it illegal? I said, yeah, Congress never authorized us to do that. So, oh, I didn't know that. I really want to say, so could you please tone down the fact that you have a PhD from MIT? You should have learned that. But my point in that is, here's a guy who is well-educated in economics, and he didn't know what the Fed can and cannot do. So how do you expect the average American to get that, right? I'm not blaming people. Why would they know? And I think that's what one of the many dangers to independence to the Fed is. When people think you can do more than you can actually do, you are forever disappointing them. And cynicism builds in, and disappointment builds in, and anger builds in. The Fed, we have to be very clear what the Fed can and cannot do. Look just now, or go back in September 2024 when we started a rate cutting cycle. We took the federal funds rate down, but the rate that people really care about, their auto loan rate, their mortgage rate, their credit card rate, it went up. The long end of the yield curve, the 10 years, et cetera, went up. The Fed does not control those rates directly. The market does. And that's the frustration I think you're going to feel now. If the Fed decided today, which it will not do, that yes, we're going to listen to the president, we're going to drop rates 200 basis points from the short end. What do you think would happen? Well, we can see it right now in the bond market. The long end has not moved at all. In fact, it's gone up some, even though the Fed cut 25 basis points. In fact, it would send a signal, I think, that the Fed is losing confidence in the economy, and that's why it thinks it has to go in and rescue it. And this is, by the way, another myth that people have. The Fed has secret data nobody else has. Fed has secret sauce. They don't. We use the same data. We see it at the same time the public sees it. There's no secret sauce. But they believe that. So if they see the Fed taking a drastic step that way, they're going to think a recession's coming for sure, because look what the Fed's doing. This would run counter to what the administration wants to do. And so I think it's really important that Americans understand the Fed has a very limited toolkit, and it can only, but there's one place where it can actually affect the long end of the yield curve. And that's in exigent circumstances where it conducts large asset purchases or quantitative easing, as the public calls it. But that's a tool you want to use very, very rarely. In some cases, people would argue, if at all, again, but that is not a normal tool for monetary policy. And so you cannot think the Fed's going to do what the Japanese have put in, yield rate control. It's just not going to happen. So that's one of the issues I'm worried about, is the people thinking the Fed can do more than it can actually do, the administration thinking it can do more than it can actually do, and they'll be disappointed, forever disappointed.
Yeah. And that independence, I imagine, is part of what causes the US dollar to be kind of the reserve currency around the world.
Absolutely.
That it's a safe place to park money and funds the borrowing of the US government.
It's part of that. I mean, I think the actions of the Fed contribute to that. Our rule of law contributes to that. There's a host of reasons why the dollar has this exorbitant privilege, as de Gaulle called it, very disparagingly called it.
And so, given that, in the importance of independence, what are your thoughts on the appointment of Stephen Mirren as a Federal Reserve governor? He's widely recognized as the architect of the administration's new tariff policies and income tax cuts, as well as continues to hold an advisor role in the White House. Should we be concerned that someone who's kind of guiding fiscal policies would now also be involved in setting monetary policies? Or what are your thoughts on that?
So my view is a little nuanced. The president has every right to, as long as the Senate confirms them, it has every right to appoint whomever he or she wants as a Fed governor. By the way, Fed presidents have a whole completely different process for being appointed, which actually strengthens independence. We could talk about that or not. But I'm perfectly okay, because that's the way it is. The president won the election, he gets to choose. I'm not okay with somebody just taking a leave and having allegiance back to the White House, because the job in the White House could be yanked any time. So there's a tie. I think to maintain that independence means you got to be independent. That means you got to sever those ties. I mean, when you go into the Fed, I severed every tie. I had to drop all kinds of corporate boards I was on, all other kinds of activity. When you make this commitment to public service, you're making a commitment to solely focus on the Fed and its role. That's what bothers me about this. Not that him per se, I don't even know him. Not that the president gets to appoint this person, that's his right. It's also having a day job. That's dangerous.
Got it. Yeah, that's the independence part of it. Now, from a historical perspective, in your view, how should we interpret, recent efforts to either fire the Federal Reserve chairman or fire a sitting governor or what have you? Do these represent kind of an evolution of past pressures, or are they truly something new and different and unprecedented?
I think, well, Nixon did it with Burns back in the 70s, really put the thumb on the scale. But this is, I hate to use the word unprecedented, because that word is being used so much every day by the media. But this does, at least in recent memory, recent history, this is quite unprecedented. Look, presidents have always been irritated at the Fed, because every politician wants to juice the economy when the elections are coming. And if inflation comes up later, oh well. And the old William McChesney Martin line, they take away the punch bowl, that's the Fed's job, to not do those things. And so the central bank is in a position often to do things that are short-term unpopular, but long-term essential. So yeah, it's dangerous. I mean, there is no case that one can cite of where politics has taken over, politicians have taken over a central bank, where it's turned out well. Just look to the South. Several countries right now in Latin America, you can look to Turkey, we can look, I mean, we don't even have to go back in history. We can just look around the world. This never, ever turns out well. And you may think you're smarter than the average bear and you can pull it off this time. I don't know. I'll go with history. I just think the odds of you being able to pull it off, to politicize the central bank, and it'll turn out well, are near zero.
Yeah. So, arguably the backstop to this independence in theory would be the Supreme Court. They have in the past issued statements kind of seem to acknowledge that. Is it your sense that that will continue to be the case? I suppose no one knows, it's a crystal ball, but
Sure.
what's your view on that?
Yeah, nobody knows for sure what the court's going to decide, but they've hinted at some things, which give me some comfort. I mean, there's in the Humphrey's executor cases, they've already signaled that the Fed is different. And the same in a case, Trump versus Wilcox. So there are at least hints that the courts think that the Fed is different. And so my view is, look, should the Fed never change? Should the Fed not? No. I mean, Congress created the Fed. By the way, after two failed attempts at the central bank in America, which are both here in Philadelphia, the first and the second banks, right on Third and Chestnut, Hamilton's Bank and what's called Biddle's Bank. The Park Service, by the way, Park Service owns those. They're bringing the first bank on as a museum of American commerce and banking, which will be cool for Philadelphia. I'm going to do an ad right now. So we have coming up here in 2026, the 250th anniversary of our country. And this is the birthplace of central banking in Philadelphia. So they're going to be opening that museum up. And there's a cool tour that you'll be able to take of the history of banking and central banking. You can go to the Mint. There's only two mints in the US, us in Denver. And then you can come across to the Fed with a new exhibit talking about modern central banking and modern banking. So there's a whole tour of history from the history, the beginnings to the current day, which is pretty cool. So Congress created the Fed. Congress can change the Fed. I have every right to do that. They're the elected body of the people. I think that's appropriate. If Congress wants to change the Fed, change its mandate, change the appointment process, change whatever, fine, have at it. Have a debate, have a vote. One person or one court should not have that power. I mean, this should be in the hands of the people, us, the people, through our elected representatives to decide, not one person in the White House or one court. I really believe this strongly, that we got to fight for this.
Thank you. That's helpful. Now, let's turn our attention to the Social Security. Kind of long-term solvency, includes proposals to open it to investment types. Now we've seen, a move to allow cryptocurrency investments in 401k programs and so forth. From your perspective, what are some of the economic risks or benefits to some of these things, from a central banker's perspective?
Well, look, so Social Security needs help, no question. The fiscal side of the business overall needs help. But again, I point you back to Ken Smetters and his team's work with the Penn-Wharton budget model. They've done tremendous analysis on solutions, possible fiscal solutions. Here's one where I do think, so I've tried very hard. When I was at the Fed, people would ask me, because typical thing in monetary policy, media, are you a hawk or a dove? I had a great answer at the time because I'm from Philadelphia. I said I'm an eagle on right. Now people ask me, am I Democrat, Republican? And I've decided to call myself a pragmatist. I'm just a radical pragmatist, a purposeful pragmatist, whatever you want to call them. I just want reasonable stuff to get done.
Yeah.
Social Security is one of these areas where I think we need that kind of thinking. Some people on one side will say, never, ever touch Social Security in terms of what they can invest in. And then you got the other side saying, let's go wild. Let's put crypto in there. Even though we don't really understand the dynamics of the crypto industry. It's never been through a significant economic downturn.
Right.
So my attitude on this is we got to open up the aperture here and of our thinking, but not so wide as we let crazy in, right? Or potentially crazy or untested in.
Mhm.
So yeah, I do think there's certain things we need to consider to try to get one of the ways that you're going to solve the problem with Social Security is you got to get better returns. To get better returns, you've got to think about a wider array of things to invest in. But we have to do that very, very carefully, right? And we just can't do it. I mean, again, crypto. First of all, there's many versions of crypto, right? There's various renditions of that. So, which one? How do you think about it? That stuff is still too new. It's not tested. Uh, but you can imagine other investments in Social Security, like any traditional pension plan. I mean, if you think of it more as a pension plan, so I chaired the investment committee for the Fed. The Fed has its own pension plan. So, we were very cautious. We were very conservative investors, but we invested in a wide array of asset classes, just to make sure that it, it wasn't going to be on the taxpayer, that we could get a decent return to pay our obligations. So, yeah, I think there are solutions to Social Security, but we've got to be willing to drop the ideology and roll up our sleeves and get practical.
Great. So let's take a couple of questions from those who are listening. We do have a question from Catherine Korostoff. Can you define stagflation for folks? I know that's a term you mentioned before, but
Sure,
folks may not be as familiar.
So it would be inflation running above the 2% target persistently. And so the Fed, the ECB, other major central banks have a 2% inflation target for good reason. Zero is a bad idea. You need a little bit of inflation, but not too much. It's the Goldilocks kind of thing, right? But inflation here is running above 2% target, and you can't get it down. And unemployment's going in the wrong direction, is going up. So we're starting to see labor market weakening and inflation going up. And in that case, normally you would see a situation with, if the labor market was weakening, the natural thing for the Fed to want to do is cut rates to stimulate the economy so people get hired. Or if inflation is running too high, you raise rates. But now you've got things moving in opposite directions, and that's stagflation.
Got it. Here's another question from Ozge Kurtaglu. Thanks so much for an amazing session. It's wonderful to see you. When or will the US dollar lose its status as an international currency of trade, in your view?
It's going to take, if it happens, and it's an if, it's going to take a while. I mean, the vast majority of contracts in the world are written in dollars. There's no obvious currency that would take over the role. The euro's been trying for a long time to be that, and it hasn't done it yet. Doesn't mean it can never do it, but it hasn't done it yet. Chinese, yuan would love to take over that role. But this again gets back to, why is the currency of choice? It's not just the depth of the market that you can trade in, which is deep in the US in terms of treasuries, but it's also trust. All of money comes down to an issue of trust, right? The only reason it's worth anything, the paper it's printed on, as they say, if it's worth, is because you trust it is, which means you trust the people backing it, which means you trust the US government. That's a trust we've earned the hard way over a long time, centuries, but we can lose it quickly. And that's the biggest risk. The risk to the currency is not some financial maneuvering here or there. The risk to the currency is the risk due to the lack of mistrust, due to the lack of trust in the US government and our rule of law. That is why the period of time we're in is so dangerous.
Thank you. That's helpful. Here's another question from Harold Bodie. Is a reduction of the Fed balance sheet required? Can the elevated level continue forever as a new equilibrium?
Good question. This is actually an area I spent a lot of time on, myself and my team, including my research director, a guy named Rock, our mentor. We actually developed the way the Fed is normalizing the balance sheet. So it was once the case. The way monetary policy was conducted is you had a small level of reserves, bank reserves, And the open market desk in New York traded Fed funds very actively. That worked for a while, but there's a lot of reasons which we don't have time to go into here. There are a lot of reasons that we decided several years ago that that system no longer made a lot of sense for the US. So we went to what we call an ample reserves regime. That is, we're no longer at a place where there's a sloping demand curve for reserves, but we're on a flat portion of the demand curve, and we set the rates with what are known as administered rates. These are rates that the Fed pays the banks the rate for their deposits, basically their reserves. There's a couple other technical rates in there. There's something called the overnight reverse repo rate and so forth that trades in the market. And that creates a corridor for which the Fed funds moves around. And so you need enough reserves, but not too many. Where exactly that level is not easy to predict. We thought we knew where it was last time we tried this before everything went to hell with the pandemic and so forth. But we were wrong. I mean, the level is much higher. So what's on the balance sheet? So you've got a bunch of liabilities as well. Currency is one. Hard currency is not dead yet. It's still out there. By the way, about 2/3 of U.S. currency is held outside the United States. Because it's trust. If I can get a dollar bill, I'm going to hold on to it, especially in a high inflation country. So you've got liabilities, and currency just grows naturally, so you do grow the balance sheet over time as the economy grows. You need to let that happen. But we need to shrink it right now. Exactly where that level is, we don't know. My attitude is we're pretty close to the appropriate level. So at this point, we should just stop the runoff, let it just go sideways, and then the other liabilities that build up will eat through the reserves. The other big chunk of the Fed, is what's called the Treasury General Account, where the government's bank. So that number bounces around a lot, depending on how the government's funding itself and how it's spending. Like, for example, the situation, unfortunately, I think we're about to be in, where we're going to possibly shut down the government. That will have a significant negative effect on that TGA account. They'll have to drain the account just to keep trying to pay the bills.
I see. Hey, here's another question from a mutual friend of ours, Rich Parada. Feels like I'm back in ops class, Professor. Thank you. How do you see the outputs of the central banks in Europe as they try to deal with growth challenges impacting the decisions of the Fed? Is Europe still relevant?
Oh, I think Europe's very relevant. I mean, as part of the overall geopolitical system, very relevant. I mean, look, we are going through, whether you think it's good or bad, we're going through a quite significant shift in global alliances right now. And I think Europe right now feels pretty good about itself, that it is potentially playing a much larger role in the global economy as the U.S. backs away. And that in particular in relationship with China and some other countries. This is where some of the risk is that we lose our leadership. And I think Europe's, whether they can do it or not is an open question, but this does provide an opportunity for that.
Interesting. Here's another question from Timothy Herod. Please talk about the Fed Reserve balance sheet. This is a little bit redundant. Maybe you've covered this. Size compared to pre-2008 and pre-COVID. How does it get down without driving up yields? Ability of the Fed to have dry powder ahead of the next financial crisis, that kind of thing.
No, it's not going to go down much longer. I mean, it's like I said, I think it's getting close to where it's going to be.
Got it. Here's our last one from Cindy Wanon. For companies that borrow heavily, how should they be thinking about the balance sheet risk in the current environment? Any thoughts there?
I don't know what she means by balance sheet risk. Well, so if we mean more the fiscal situation, which, by the way, 3 months ago I couldn't talk about because we didn't cross that line. The Fed did not criticize fiscal policy, and the fiscal side normally didn't criticize the Fed as much as they are now. But hey, new world.
Right.
We got ourselves a real problem that we need to deal with when it comes to the deficit. There are solutions. There are ways we can address this. But again, we got to park ideology and roll up our sleeves and solve this problem. So in the short run, do not expect long rates to go down anytime soon.
And is that because of the deficit?
Yeah. I mean, look, again, Smetter's team estimates over the next 10 years, we'll put another $3.5 trillion on top of everything else into the debt deficit.
Yeah.
So we're issuing a lot of paper. So it's a basic question of supply and demand.
Right.
If we're putting a lot more supply of paper on the street and we're not seeing a surge of demand around the world, the only thing that can happen is price goes down and rates go up.
Yeah.
That's it, right?
Got to pay more to get it.
So why, again, would you expect anything different? I mean, you shouldn't. It's not going to happen. So this is where longer rates just aren't going to move that much.
Got it. I'll sneak in one more question from Paras Bhargava. Some global central banks are increasing gold reserves and decreasing their holdings of US dollars. Is this a harbinger of anything in your view?
Well, I think this gets down to, again, people losing some faith in the US. It hasn't cratered. It hasn't fallen off the cliff. Let me be clear. But people on the margin are saying, yeah, maybe we should hedge our bets. Maybe the US is not as safe a bet as we thought. Oh, and you see that, right? In just the devaluation of the dollar. I mean, you're seeing the dollar drop, and that's why would you expect anything else given, I mean, if you're sitting in some other country and some other world capital and seeing what's going on here, what would you think?
Yeah.
You think chaos. Right or wrong, whatever side of the issue you're on, there's just chaos. And that's the perception. So people are going to hedge their bets. I would.
Yeah, makes sense. So we're just about out of time. Any closing thoughts you would like to leave folks with as they think about the Federal Reserve and the economic environment that we're in right now?
No, other than back to my purposeful pragmatist or valid pragmatist, we need to break through the ideology. We need to park that. It's not helping us. We need to really focus on, we got a lot of problems in front of us, but a lot of opportunity. We got to start rolling up our sleeves, thinking about what we're going to do, how we're going to do it, and how we're going to, I think about the, I mean, this sounds trite, and I know it does, but I've got 8-year-old twin granddaughters. I don't want to leave them in this world the way it is right now, in this country the way it is right now. We got to do better. And the only way to do better is to stop demonizing each other. And this is, I think, the whole theme of what you're
That's
talking
exactly
about.
what we're here for, right? To bring people together.
Stop demonizing each other and just let's get down to work. Enough of the crazy ideologies.
Thank you, Pat. This has been a really insightful and thought-provoking conversation. I'd like to thank our listeners today as well for their time and thoughtful questions. And be sure to join us for our next episode of the Unity Forum on Tuesday, October 21st at 1 p.m. We're still finalizing the details, but we hope to be talking to Dr. Ronnie Janoff-Bowman, Professor Emerita at UMass Amherst and author of the book, The Two Moralities, Conservatives, Liberals, and the Roots of Our Political Divide. I've been reading this book and have been thinking it might help me navigate some of those visits with my extended family over the holidays when conversations unexpectedly veer into political discourse. But in any case, it's sure to be another insightful and thought-provoking discussion. So until then, thanks again and have a great day.
Thanks for listening today. If you enjoyed this episode of the Unity Forum, please give it a rating, share it with others, and join us on Facebook at Alumni for Freedom and Democracy. And be sure to join us next time for another thought-provoking discussion on the big ideas shaping our collective future.